Stop watching the stock market. The real signal is not the price on a ticker. It's the quiet, unanswered request for physical delivery. In part 1 of this series, we showed how stablecoins unbundle bank funding, accelerating the exit of liquidity from the system. In part 2, we follow that pressure to find the first market to break. The signal isn't price, it's availability. The damage is already visible. Physical silver inventories in the London and New York vaults are being drained. The market has been in a structural deficit for 5 consecutive years. This isn't a story about charts. It's about the raw, physical world smashing into the fragile world of paper promises. Most people watch price. This channel tracks the mechanics of failure. In a crisis, liquid markets like stocks are the last place to show fundamental stress. The trouble starts where things become impossible to get. A liquidity crisis is a crisis of trust. It's the moment everyone asks if the other side of their trade can actually make good on their promise. This is where the system's cleverest tricks become its greatest weaknesses. Take rehypothecation. A broker uses your assets as collateral for its own borrowing. The same ounce of metal can be promised to multiple people, creating a pyramid of paper claims on a tiny physical foundation. This system works only as long as everyone doesn't ask for their physical asset back at the same time. It creates immense leverage where the amount of paper claims dwarfs the amount of actual physical metal. When trust evaporates, the game stops. Everyone holding a paper promise scrambles for the real thing. It's not about predicting daily price fluctuations. It's about understanding the structural reality of a system consuming its inventory to survive. The first domino will fall in a market our entire modern world is built on, but has completely forgotten. While gold is held in vaults, silver gets consumed. It is destroyed. Over half of all silver demand comes from industry, where it is a critical, unsubstitutable component. Every electric vehicle, every solar panel, and the infrastructure for 5G and AI all depend on silver. This isn't investment demand that backs off when prices rise. This is relentless, non-negotiable industrial consumption. A company building a gigafactory doesn't care if silver doubles. Their assembly lines shut down without it. This demand is inelastic. It doesn't bend. It breaks things. This relentless appetite is colliding with a brutal reality. For 5 years running, the world has been in a structural silver deficit. Demand has outstripped all supply from mines and recycling. The cumulative shortfall from 2021 to 2025 is estimated to be almost 820 million ounces, roughly an entire year of global mine production gone from inventory. Worse, silver supply is just as inelastic as its demand. Around 70% of all silver is mined as a byproduct of other metals like copper and zinc. Mining companies can't just flip a switch for more silver. They need the economics of a giant copper mine to make sense, a decade-long process. You have price-insensitive industrial demand, a multi-year structural deficit, and no way to quickly increase production. That is the dry tinder. A global liquidity crisis is the spark. The price you see on your screen isn't for physical silver. It's the price of a paper promise, a futures contract on an exchange like the COMEX. This system runs on one fragile assumption. Over 99% of contracts will be settled in cash, not metal. But when an industrial giant stands for delivery, they don't want dollars. They want the silver. This is the moment the paper market's bluff is called. As industrial users force delivery and drain the already low inventories, the consequences escalate non-linearly. First, premiums for immediate physical delivery skyrocket. Second, lease rates, the cost to borrow physical metal, go vertical. Third, price spreads between markets like London and Shanghai widen dramatically as everyone scrambles for the remaining metal. This leads to the final system-breaking move, the no-offer event. The exchange, unable to source the metal, breaks its core promise and forces a cash settlement on the buyer. It is the official admission that the paper claim is worthless. The instant this happens, trust in the entire paper market evaporates. The price of paper silver collapses as holders flee their worthless claims, while the price of actual physical silver, if you can find any, bifurcates, going to multiples of the paper price. This is physical reality reasserting its dominance over the paper promise. If the silver market breaks, gold doesn't fail in the same way. Silver breaks. Gold freezes. The gold market has similar paper leverage, but its demand is monetary, not industrial. It sits in vaults. It isn't destroyed. When a liquidity crisis hits gold, the failure mode isn't a no offer, it's a logistical breakdown. You'll get a not yet. Delivery times will stretch from days to weeks, then to months, with excuses about transport, administration, or vault backlogs. This is the system buying time, desperately trying to find unpromised physical metal. The most important question becomes custody. Will a government suddenly restrict the export of gold from vaults within its borders? You may own it on paper, but you won't be able to get it. Access is shut down. Silver breaks first because industry forces the delivery question. Gold freezes second as investors realize their paper claims are just that, paper. The next crisis begins deep in the plumbing of the financial system, with relentless industrial demand crashing into a structural supply deficit years in the making. The silver market is the canary in the coal mine because its unique role as a consumed industrial metal makes it the first domino. Watching inventory levels and delivery reports gives you a clearer view of the coming storm than any stock chart. This channel tracks the mechanics of systemic failure. In part 1, we showed how stablecoins accelerate the exit of liquidity. This video showed where that pressure leads. A failure to deliver in a market where paper promises collide with inelastic physical demand. But when the system can no longer deliver assets, and cash settlement is exposed as a broken promise, where does value finally settle? Watch part 3 of this series now, where we analyze the role of Bitcoin as a final, unencumbered settlement layer beyond the control of any counterparty.